My biggest investing mistake was
I was reacting just based on emotion.
It's a little shady and everyone's saying, oh, invest in it.
That's when I realized
I would have made a lot more money.
I need to diversify.
I learned that the hard way.
Everyone here started investing in the stock market in 2020. They're part of the surge in retail investors who began buying stocks last year, many with little to no investing experience or education. That meant learning on their feet pretty quickly as the market whiplashed. The stock market crashed in March 2020 before rebounding and soaring to record high after record high.
I started investing a little bit before COVID struck the US, and I had no strategy. I didn't know what I was doing. When the pandemic hit and the market crashed, I actually freaked out. I let emotion get in the way and I panic sold a lot of my stocks. I, of course, made a loss, and I realized I really needed to do a lot more education about how the stock market worked.
Here are 6 key takeaways about investing in the stock market from retail investors who got started in 2020.
I do feel secure in my financial foundation. The money in my brokerage account is really just for me. It's money I was willing to kind of lose and play around with. If I lost the money in my brokerage account, I would be okay with that.
Having a well-diversified portfolio that's on autopilot and then supplementing it with a portfolio of individual stocks that perhaps are traded more frequently doesn't strike me as unreasonable, especially for investors who really want to participate in the market and like researching and tracking individual stocks.
Experts recommend investing just 5 to 10% of your portfolio in individual stocks. Park the rest of your money in low-cost, highly diversified index funds, ETFs, or target date funds, which are baskets of securities that reduce risk. Then invest a set amount of money into these assets on a regular basis. Hold on for the long haul and don't worry about the stock market's daily gyrations. But before you do anything, make sure you've paid off debt, built an emergency savings fund, and taken advantage of your workplace retirement plan, if available.
When I started panic selling my stocks, I of course made a loss. So then I learned how to be patient with myself, how to remove emotion from my investments and trading. I started researching companies, learning how to evaluate them better.
The big concern with investors dabbling in individual stocks, especially after they've already appreciated a lot, is that their valuations just aren't what they once were. So the prices of those stocks have escalated commensurately, obviously. In order for their prices to continue to do well, the companies will have to deliver that much more. So the concern is that investors getting into them now could be a day late and a dollar short. Whether you're using something more sophisticated like a fair value metric or you're using a price earnings ratio, you definitely need to pay attention to the valuation because that will be an important determinant of the stock's future returns.
the craziest risk I took was on Uber. I was being told to sell it. I think just sticking to your guns and just holding on. Because I bought Uber at like $30 and then it's now 53. And I bought 100 shares of that. I haven't sold anything yet. I don't think I'm gonna be pulling any of my money out.
Warren Buffett has said that his ideal holding period is forever. And I think that that's a great mantra for individual investors to keep in mind if they make investments and they've really put some thought into what those investments are. To the extent that they can hang on and be patient, that will tend to influence better investment results.
Another strategy I had was not just investing in big name companies that everyone knew about, but investing in companies along their supply chain. So manufacturers, transportation, and other companies that support their business. A lot of the big name companies now, their share prices are pretty high for people starting off.
I love the idea of digging below the companies that have paced the market and looking at other companies that maybe aren't quite as sexy but stand to benefit from similar trends. It definitely seems like a good starting point to get yourself into sort of a growth at a reasonable price basket of companies.
I invested in some oil company. It was a little shady, and everyone's saying, oh, invest in it. And it tanked, I think 30-40%.
Social media has definitely played a role in fomenting excitement around stocks this time around. And as investors, we need to be really careful about who we get information from and recognize that some people imparting information may have some malevolent interest. They may have some lousy company that they want to unload that they're trying to get other people excited about.
But experts say most retail investors don't need to learn everything about how the stock market works. As long as they invest for the long term in highly diversified assets like index funds. But if you do have extra money to play with and plan on taking more risk with it, remember to take the emotion out of investing and make sure to do your homework.